Right, I think it's 8:33, so I think we'll make a start. Welcome to our Spring 2021 Financial Reporting Seminar. We'd rather be doing this in person, having supplied you with a nice sausage sandwich and a cup of coffee, but we found that Zoom is a reasonable second best, and I hope that you've all supplied yourselves with appropriate refreshments. For those of you that don't know me, I'm Craig Burton, a commercial partner here at Hawsons. I act for clients in a broad range of sectors with a focus on manufacturing, engineering and architects. Most of my clients have audits, but I do act for a number of businesses below the audit threshold too. I also act as the technical partner at Hawsons, responsible for maintaining technical standards throughout the firm. Paul, would you like to introduce yourself?
Good morning, everyone. I'm Paul Hutchings. I'm one of the audit managers here at the Sheffield office of Hawsons, and I look after a wide portfolio of corporate clients, predominantly owner-managed businesses and SMEs. I also have the role of technical director at the firm, so I work closely with Craig to help our partners, staff and clients keep up to date with latest auditing and financial reporting developments.
This presentation is headlined Current Issues in Financial Reporting for SMEs. So we're going to presume that you're all following FRS 102 or FRS 102 Section 1A, not IFRS. We did give a similar presentation back in December, so if any of you were at that presentation too, this will mainly be a reminder, although there have been a couple of developments since, which we will cover. At the advent of FRS 102, the FRC said that they didn't want to make regular piecemeal changes to the standard, and that they would save up all the changes and make a number of changes every 3 years in a triennial review. The last triennial review was published in December 2017, effective for periods commencing on or after the 1st of January 2019. And a request for views of areas to be covered in the next one has only just been issued. So there are not many accounting standard changes to discuss this morning. Having said that, in response to COVID-19, the FRC have published one amendment to FRS 102 relating to rent concessions, which Paul will cover later. He'll also look at the application of FRS 102 to the various different loans and grants that have been available to businesses this past year. Before that, I will look at the impact of COVID-19 and Brexit on financial reporting, focusing on going concern, but also thinking about other areas which may have been impacted. As well as looking at the specific impact of COVID-19 on rent, grants and loans, Paul will look at the impact of Brexit on financial reporting for groups. Paul will finish up with a reminder of the 2017 triennial review, as well as looking into his crystal ball for items that might be included in the next one. You may notice that the slide now calls it a periodic review rather than a triennial review, but more of that later. Audit reform has been in the financial press quite a lot lately, and I'll pick up briefly on that at the end of our presentation. Please use the chat function to note any questions as we go through. Paul and I will answer any questions at the end. So let's start with topical areas of COVID-19 and Brexit. The first thing I want to look at in this section is going concern. Following the well-publicised corporate failures of recent years, BHS, Carillion, Thomas Cook, to name but a few, going concern has been a topic high on the profession's agenda for directors and accountants and auditors alike. In response, at the end of 2019, the FRC published a new audit standard on going concern that's effective for 2020 year ends, which means that your auditors will now have to do more work to get comfortable around what the directors have done to ensure that your company is a going concern. A few months after the publication of that new audit standard, the COVID-19 pandemic hit, with all the uncertainty that that brought, which raised questions about what the going concern assumption meant in the times of a global pandemic. Very usefully, back in May 2020, so at the height of lockdown, the ICAEW, together with the ICAS, issued guidance for directors on their responsibilities for going concern. That guide reminded us that all accounts, including statutory accounts, measure past events, but they are prepared on a going concern basis. That is, assets and liabilities are measured and classified on the assumption that the entity can continue to trade for the foreseeable future. The most obvious example of this is a piece of equipment that's been purchased. It's measured at cost and included on the balance sheet as an asset, as the entity will generate future economic benefit from that asset. In a company, it's the directors' responsibilities to assess going concern. When they are preparing the accounts on a going concern basis, they need to ensure that that basis is appropriate. Your accountant or auditor is likely to ask for evidence that you've done this, particularly if you're subject to audit, given the new auditing standard on going concern. So what evidence can you show your auditors that you've considered the going concern assumption? Ideally, you'll have some cash flow forecasts which cover the foreseeable future. And for both directors and auditors, this needs to cover a period of at least 12 months from the date of the approval of the accounts. Companies have 9 months to file their accounts at Companies House. Incidentally, the 3-month filing extension given because of the pandemic has now been withdrawn. So the period that needs to be covered by the cash flow forecasts could be significantly more than just next year's budget. For example, a December 2020 year-end company whose accounts are signed off in September 2021, their 2021 budget will only cover a period of 3 months from the approval of the accounts. Definitely a shorter period than the foreseeable future. Cash flow forecasts should be used to identify any cash shortfalls in the period, or even just points where the headroom becomes tight. And directors need to plan actions to prevent or mitigate those shortfalls and demonstrate those plans to the auditors. And cash flow forecasts are much better evidence than profit and loss budgets. As we all know, cash is king and profitable companies can run out of cash. Preparing forecasts is looking into the future, so everyone recognizes that it's not a precise science. Directors need to make assumptions, apply them consistently, and be able to defend those assumptions. As directors, you need to test the forecast for different assumptions, both downside and upside. And developing a range of expectations can help you to identify the need for business critical decisions. A term that's been spoken a lot recently is the reverse stress test. This means identifying the assumptions that result in the company running out of cash, and hopefully being able to show that the likelihood of those assumptions actually happening is remote, or that the directors can take appropriate mitigating action to prevent the company running out of cash. And when developing your forecasts, remember a cautious approach is best. You don't want to base your forecasts on, for example, unrealistically high sales expectations. When preparing the budgets, directors need to think about the impact of COVID and Brexit when preparing those budgets and forecasts. For example, regarding Brexit, many businesses may find the switch to a new relationship with the EU relatively seamless if they have limited trade with suppliers or customers on the continent. However, for many more, this will have been a challenging time for them, and we need to think about the financial impact of those challenges. Sales contracts could become less profitable due to customs duties, tariffs, delays, and exchange rate movements. Worst case, contracts could become onerous unless the business is able to renegotiate terms. All these factors need to be considered when thinking about the company's ability to continue in business and the appropriate disclosure to be made in the accounts. Particularly where the business is heavily dependent on the support of shareholders or third-party funding for its continued existence as a going concern. Confirmation of that support may not be as forthcoming in this economic landscape, and any confirmation required should be obtained as soon as possible. As well as going concern, directors need to be aware of other potential impacts of COVID-19 and Brexit on their financial statements. One area to think about is the impairment of assets. COVID or Brexit may have impacted the recoverable amounts of assets, possibly leading to the need for impairment provisions in the accounts. So we need to be alert to impairment indicators specifically resulting from COVID or Brexit. When reviewing property, plant and equipment for impairment, we consider whether there are any indications that the recoverable amounts are below the carrying amounts. We do need to remember that the recoverable amount of an asset could be its value in use to the business, if that is higher than the market price it could achieve if sold. So even if commercial property values are adversely affected by, for example, a post-Brexit slump, if the property is still fully utilised in the business rather than surplus to requirements, the carrying value in the accounts may not be affected. We still need to review the useful life of the asset, as that might be affected, with a follow-on impact on the depreciation charged. Stock and inventories are reviewed for impairment on an annual basis, and we'll have to consider whether Brexit has created an adverse legal landscape which could affect our ability to sell stocks into our usual markets, or significantly increase the costs of doing so. There could also be other issues. For example, a decrease in the availability of labour supplied by EU workers could push employment costs up. COVID could have an impact here too. Has the latest lockdown resulted in stock purchased back in December becoming obsolete in the months since? So there could be factors that either bring the net realisable value of stock down or push the cost up, which may lead to provisions being needed against stock where previously there were no issues. We need to think about trade debtors too. Have any of the customers been adversely impacted by either COVID or Brexit, which may result in trade debtors becoming irrecoverable? This may become more of an issue as we come out of lockdown and the government support measures such as the CBILS loans and the furlough scheme come to an end. One final point on assets. Where COVID and post-Brexit creates uncertainty, if property valuations are needed for the accounts, you should consider using professional valuers rather than relying on directors' valuations, even though professional valuations are not mandatory under FRS 102. In this landscape, directors will probably struggle to make reliable valuations, and auditors will probably expect professionals to be involved in the valuation process. When considering provisions, you need to be aware of over-providing based on Brexit uncertainty. Costs anticipated and associated directly with Brexit should only be provided if there is a legal or constructive obligation to incur those costs at the balance sheet date. For instance, if a company is pushed into restructuring, a constructive obligation to make a provision exists only when plans to restructure have been formulated by the year end and formal announcements have been made to those affected by the plans. Just having an intention to restructure at some point in the future is insufficient grounds to recognise a provision. Any of the adjustments that we've discussed could lead to breaches of bank covenants. These need to be communicated early to any lender and, if possible, get the covenants waived before the year end. Any breaches of covenants which haven't been waived at the balance sheet date could result in all of the loan liabilities being classified as current liabilities in the year-end accounts. Given the high degree of uncertainty caused by the new business landscape, it's likely that directors will be more than ever required to make judgments and estimates that significantly affect the accounts. Directors need to be prepared to disclose those judgments and estimates in the accounts. Disclosure should focus on the specific amounts in the accounts that are at risk of material adjustment in the next year, should judgments and estimates change. As usual, but particularly in this environment, to capture all of the material impacts of the departure from the EU and any COVID changes, directors should plan to undertake a comprehensive post-balance sheet event review. When you've done that review, you need to consider whether any information found provides evidence in relation to circumstances that existed at the balance sheet date, which would mean it was an adjusting post-balance sheet event required to be reflected in the amounts in the accounts, or whether it relates to a circumstance which arose after the balance sheet date, which, although ultimately impacts the amounts recognised in the accounts, would be a non-adjusting event only, requiring disclosure in the accounts, with the amounts left unadjusted and the impact to be felt in the following year. With the transition period ending on the 31st of December and the new relationship with the EU beginning on 1st of January, this could present challenges for December 2020 year ends in particular, as it may be difficult to establish whether an event after the year end in Q1 2021 related to conditions existing at the balance sheet date or not. Many December year ends will now be finalised and signed off, but for those that aren't, there's scope for different interpretations to be taken. So be prepared to back up any judgment calls for your auditors. Any additional judgments and estimates in the accounts may give rise to more disclosure, even for small companies applying Section 1A of FRS 102. This is because of the overall true and fair requirement, which requires directors to make disclosure over and above those that are mandatory if such disclosure is necessary for the accounts to show a true and fair view. This is where a strategic report or director's report could be useful to provide context to a reader of the accounts and give an insight to the company's future post-Brexit and its ability to deal with the anticipated challenges and uncertainties. Small companies aren't required to file a director's report with the accounts, but they can always choose to do so if they think it would be helpful for an outsider user of the accounts to better understand the position the business is in. I'll now hand over to Paul, who'll firstly take us through a couple of specific accounting issues relating to the COVID pandemic.
Thank you, Craig. To help them through the pandemic, many businesses that lease property have been granted rent concessions by their landlords to support them through. Now, before the pandemic, FRS 102 didn't explicitly specify how to account for changes in lease payments resulting from rent concessions. So to avoid having businesses interpreting FRS 102 in different ways, the FRC had to act fast to issue an amendment to FRS 102 looking specifically at COVID-19 related rent concessions. The amendment to FRS 102 was issued in October 2020. It applies only to rent concessions given by landlords as a direct consequence of COVID-19. Now, prior to this amendment, businesses may have looked to treat these rent concessions in the same way that lease incentives, such as rent-free periods at the beginning of the lease, are treated, and spread the benefit over the remaining life of the lease. But this amendment says you don't do this. These concessions were specifically to help businesses out during the pandemic and are therefore temporary in nature. And so they should be recognised in the P&L in the period that the concession is intended to compensate. So effectively, you recognise the reduction in the rent charge as it happens. Now, there are certain conditions to be able to apply this treatment. Firstly, the change has to be a reduction in rent. And the amendment as drafted in October 2020 says it only applies to reductions in rent payments which were due on or before the 30th of June 2021. However, the FRC have just issued an exposure draft, FRED 78, in which they propose extending that period by a year to 30th of June 2022. And the other condition is that there has to be no other change to the terms of the lease. Otherwise, the rent concession could be said to be due to those changes rather than just COVID-19. There's also a disclosure requirement. You need to disclose the change in lease payments in the accounts. And the effective date for this amendment is periods commencing on or after 1st of January 2020, but early application is permitted. Now, rent concessions are one way in which businesses have been supported through the pandemic. The government has also made available an extensive array of initiatives to support businesses and help them survive. Businesses are therefore making use of various loans and grants, the financial effects of which need to be reflected in the accounts. So I thought it'd be useful just to take a quick look at how FRS 102 applies to those. Looking at grants firstly, FRS 102 allows an accounting policy choice for government grants, with businesses able to follow either the accrual model or the performance model. COVID-19 grants are revenue-based grants as opposed to capital grants, so the accounting treatment is the same irrespective of the model that you apply. So in terms of coronavirus job retention scheme grants or furlough grants, we recognise those in the P&L separately as other operating income. There's no offset against the wages and salary costs. And any grants that we've applied for at the year end that we haven't yet received, we recognise as a debtor. With SSP rebates, these are treated as government grants too. So again, we recognise those in the P&L as income as they become receivable. There's no offset against the payroll cost. And again, we have a debtor for any rebate receivable, but not yet received at the year end. With business rates relief, that's slightly different. Business rates relief isn't a grant, as there is actually no transfer of resources. We simply have a charge not being levied, and so there's no expense to recognise in the P&L. So the charge through the P&L is reduced for the period that we get the business rates relief. And small business grants, anything receivable under the Retail, Hospitality and Leisure Grant Fund, Discretionary Fund, again, we recognise those immediately in the profit and loss account separately as other operating income. Looking at the Coronavirus Business Interruption Loan Scheme, or the CBILS loans, the business receives a loan from a bank, with the government providing the bank with a guarantee of 80% of the loan. This guarantee then allows the loan to be at an interest rate lower than might otherwise have been possible, and the bank may or may not levy an arrangement fee or another initial charge. The government will make a business interruption payment to cover the first 12 months' interest and any fees applied. And although the government provides a guarantee to the lender, the business remains 100% liable for the debt. Now, whilst these loans themselves don't constitute a government grant, the business interruption payment element does and should be accounted for as such. This is often missed though, because the company doesn't actually receive the payment due to it being paid directly to the lender by the government. So in the first 12 months of the loan, a charge for the interest and the fees that are covered by the business interruption payment should be recognised in the P&L, and a matching amount equal and a matching amount of grant credit should be recognised as income in the P&L. As I say, this is often missed, and the fact that it's often missed may not be too much of an issue, as the amount of interest and therefore the matching grant income may not be material to the company's accounts, unlike, say, furlough income perhaps. However, you should still be aware of the correct accounting treatment so that you can apply it appropriately. Bounce back loans, these are very similar to the CBILS loans, they just apply to smaller businesses. So again, the government makes a business interruption payment to the lender to cover the first 12 months of interest. And so the business receiving the loan recognises an interest charge in the P&L for the first 12 months. And the business interruption payment is treated as a government grant and recognised in the P&L as income. But again, consider materiality when applying this accounting treatment. Now, I'm just going to spend a few minutes looking at the impact of Brexit on certain aspects of group financial reporting. On 31st of December 2020, the transition period ended and the UK ceased to be subject to EU law. As a result, the government issued a few statutory instruments which make certain changes to the UK framework for auditing and reporting. However, for the vast majority of companies, the UK's accounting and corporate reporting regime will remain largely unchanged. Generally speaking, companies that apply UK GAAP to prepare their accounts, which is presumably the case with most of you on this seminar today, they'll not face any changes to their reporting requirements. However, the exception to this are companies that have a parent or a subsidiary in the EEA, the European Economic Area, and we'll now have a look at what could change for these businesses. The changes concern a parent company's exemption from preparing group accounts. Firstly, there's the exemption for a parent company that is itself small and heads up a small group. Now, what do we mean by small group? Well, the benchmarks and the thresholds are there on the slide. Turnover, balance sheet total, which is gross assets, fixed assets plus current assets, and employees. If you're below at least 2 of the 3 of those on either a net or a gross basis or a mix of the 2, then you'll qualify as a small group in terms of size. Remembering that gross is before consolidation adjustments and net is after. And with the gross thresholds, it's possible for a group containing a medium-sized company to be a small group, provided the parent company is itself small. So we know what we mean by small in terms of size, but in addition to those size requirements, there are still eligibility requirements. And this is where Brexit has made a change. So we could be small, but we could still fall foul of these ineligibility requirements. So we need to make sure that our small parent company is not part of a wider group that's ineligible. Now, before Brexit, a group was ineligible if it contained a company with shares traded on a regulated market. That's any regulated market anywhere in the world. Since Brexit, the change in the regulations, a group is now ineligible if it contains a company with shares traded on a UK regulated market. So this narrows the scope of ineligibility. Up to now, if I was the small parent of a small group, but I was part of a wider group that included a company traded on a regulated market anywhere in the world, I couldn't claim the small group exemption from preparing group accounts. But since Brexit, provided that that other company in the group isn't traded on a UK market, I can be exempt from preparing group accounts. So from 31st of December 2020, it may be that more groups qualify as small, and so they don't have to rely on other exemptions in the Companies Act to be able to take exemption from preparing group accounts. So that takes us on to those intermediate parent company exemptions that may be available to a parent company that qualifies, is small but fails to qualify on the ineligibility rules. So under the Companies Act, before Brexit, an intermediate parent company could be exempt from preparing group accounts under Section 400 of Companies Act if it was included in the accounts of a larger group in the EEA, or under Section 401 if it was included in the accounts of a larger group outside of the EEA, anywhere else in the world. It's worth noting that there are requirements to be met before those exemptions can be claimed, and one of those is that the consolidated accounts of the larger group must be filed at Companies House and must be prepared in English. Now, with Brexit, the regulations that came in had the effect of changing the references to EEA within the Companies Act with UK. So under Section 400 now, an intermediate parent company can only claim exemption from preparing group accounts if it's included in the accounts of a larger UK group. Section 401 is available to those companies that are part of a group outside the UK. So you might think, well, that's not a problem, I can apply either. But Section 401 will only apply if those consolidated accounts of the non-UK parent company are drawn up in accordance with UK law or UK adopted international accounting standards. Now, at the moment, UK adopted international accounting standards are the same as EU standards. So there's no real change currently, but this could become an issue in the future if the UK and EU accounting standards diverge to the extent that they are no longer equivalent, because that would mean that the non-UK parent company would be preparing accounts in accordance with rules that are no longer equivalent to UK accounting rules, and so Section 401 wouldn't be available. So just to summarise the last couple of slides, we could potentially have the situation where, as a result of Brexit, more UK companies are able to take the small group exemption, but less are able to take the intermediate parent exemptions. So if you're a parent company or part of a larger group and you're currently taking advantage of any of these exemptions from preparing group accounts, then you need to look at these changes closely to ensure that you can continue to do so after Brexit. Just one last point with Brexit. This concerns audit exemption. Currently, a subsidiary company that isn't small could still be audit exempt if it obtains a guarantee from its parent company. Now, before Brexit, that was available to subsidiary companies where the parent company was within the EU. Now that's been narrowed, so it's only available to companies with a parent company providing a guarantee that's based in the UK. So again, if that applies to you, then just watch out for that change. Okay, I'll now move on to look at what the FRC are doing in terms of possible changes to accounting standards. For most of us, financial reporting requirements are dictated by FRS 102. Broadly, unless you're a micro entity applying FRS 105 or a listed company applying international accounting standards, then what you need to do will change as the FRC make changes to FRS 102. The FRC is pledged to carry out periodic reviews of FRS 102 to ensure it remains up to date. They'll also react to exceptional circumstances requiring amendments that cannot wait until the next periodic review, such as the amendment for COVID-19 related rent concessions that I've just mentioned. Now, initially, they said these periodic reviews would be every 3 years. And so there was a triennial review in December 2017, which resulted in the publication of a revised FRS 102 in March 2018. And with an effective date of 1st of January 2019, it wasn't really until December 2019 year ends that we first felt the effect of those changes. Now, if any of those changes coming out of the 2017 triennial review affected your business, then you'll already have become familiar with them. Some of the changes were mandatory and some were optional. In terms of mandatory changes, there was the removal of the undue cost or effort fair value exemption from carrying investment properties at fair value on the balance sheet. There was also a change to the recognition of tax relief on gift aid payments. The classification of basic financial instruments was changed to make more qualify as basic and therefore accessible to simpler accounting treatment. And there was also some disclosure amendments. There are also some optional changes. So we now have the option of treating intergroup investment property as fair value through the P&L or as property and plant equipment at cost. We can choose either. The rules regarding recognition of intangible assets on a business combination were relaxed a bit. And also where director shareholders made loans to small companies, the accounting for those was simplified. Well, that's all a little bit in the past now, and having initially said they would carry out periodic reviews every 3 years, we've been waiting for a while now for news of the next review. In the last month, the FRC have now said that periodic reviews will be at least every 5 years. So a new 6-month review has been announced, and the FRC are seeking views on the areas to be considered for review. Now, in terms of potential areas of reform, there's been some significant changes to international accounting standards over the past few years, with the introduction of IFRS 15 on how revenue should be recognised, and also IFRS 16, which radically changed the accounting for operating leases, bringing them onto the balance sheet for the first time. Now, FRS 102 was originally based on international accounting standards, so these could well be areas considered as part of the review. Any changes proposed by the review will be subject to public consultation, which isn't expected before next year, 2022. And the effective date of any changes is expected to be the period commencing on or after 1st of January 2024. So although there are no changes to worry about in the near future, which is probably welcome given everything else on our plates at the moment, it is good to finally have some clarity on when the next set of changes can be expected. So, having said my bit, I'll now hand you back over to Craig to finish with a look at audit reform.
Thanks, Paul. Following some high-profile audit failures, there's been a lot of talk about audit reform and a lot of coverage in the financial press. A number of investigations and reviews into audit quality, audit competition, and auditors in general were launched in 2019, culminating in the Bryden Review, which actually published its findings back in December 2019. The Treasury and the Department for Business, Energy and Industrial Strategy were formulating their response, and then the global pandemic hit, and other issues took priority, so it was put on hold for a bit. However, the government has picked it up again, and on 18th of March this year, BEIS published its proposals in a white paper and asked for responses to its consultation by the 8th of July 2021. The proposals within the white paper relate to auditors of listed companies and the very largest private companies, collectively known as public interest entities, or PIEs, and their auditors. The indications are that these regulations won't creep to smaller companies and their auditors, but it is early days in the process. And we're certainly hoping and are hopeful that they will just relate to the top end of the audit market. Saying that, I thought it would be useful just to touch on the main proposals which do adopt many of the recommendations from the Bryden Review. Although headlined audit reform, the paper argues that governance does start with companies and the directors themselves, so has some proposals related to those. So first of all, there'll be a requirement to disclose distributable reserves. Under IFRS and to a lesser extent FRS 102, items which aren't realised, for example, fair value adjustments like revaluations of investment property, are recognised in the P&L account and therefore can be shown in the profit and loss reserve. So the financial statements don't actually show the distributable reserves, and this proposal would address that. The paper also proposes a requirement for directors to state that the proposed dividend will not threaten solvency over the next 2 years. And public interest entities need to publish an annual resilience statement, basically setting out how the directors assess the company's prospects and how they propose to address challenges that come up. Those entities will also need to publish an annual audit and assurance policy, demonstrating the director's approach to seeking internal and external assurance of the information reported to shareholders. And there will be enhanced regulatory powers to hold directors of large businesses of public importance, PIEs again, to account for breaches of duties. In terms of auditors, there'll be a new standalone corporate audit profession regulated by the new regulator, the Audit Reporting and Governance Authority. There'll be a set of overarching principles for auditors to reinforce good practice. There'll be a duty to take a wider range of information into account, not just financial information. There'll be new obligations on auditors relating to the detection and prevention of material fraud. There'll be new regulatory measures to increase competition and reduce conflicts. One of those is a managed shared audit requirement for FTSE 350 group companies. So the auditors of those groups will need to share the audit with other smaller audit firms. And the paper proposes operational separation between the audit and non-audit practices for firms with more than 15% of the FTSE 350 market. In practice, that's just the big four, as none of the other firms, even the other big national firms, don't have more than 15% share of the FTSE 350. As I've mentioned, the new regulator will be the Audit Reporting and Governance Authority. The replacement of the FRC by the ARGA is already taking place, but the legislation to authorise its powers are included in this white paper. The ARGA will definitely have more teeth than the FRC and will be funded by a new statutory levy levied on PIE companies and their auditors. That's just a whistle-stop tour of the current proposals for audit reform. As I said, BEIS is consulting on these proposals until the 8th of July. So if you feel strongly, you could respond. If you Google BEIS white paper on audit reform, you'll find it along with directions of how to respond. Or you could contribute to the responses being prepared by the professional bodies such as the ICAEW. So that concludes what we wanted to cover in this seminar. I hope that you found the information useful, either as new issues for you to take away and think about, or as a reminder of matters you may already have had an awareness of. Thank you for joining. At this point, we can take any questions you may have. Just look on chat. I don't think there's any questions there at the moment. So if anyone has any questions, please type them into chat now. Don't seem to be any coming through. No questions coming through. So if you do have any questions that you want to email me or Paul, our details are on our website, so you can contact us that way. Yeah, just got someone who's asked if we'll send the slides out, please. Yes, we'll make sure we send the slides out to all participants. And if there's no other questions, I think we can bring that to a close. Thank you for joining, and hope to see you again soon.